David Morgan from silverinvestor.com. In this week's Currency Countdown, I was reading that the European Financial Stability Fund lost its AAA rating this week on Monday. Any thoughts you'd like to add to this?
Well, absolutely. There were several articles on it. One I pulled up was from the Telegraph, and they made an interesting case. It's downgraded because the inability to pay back the loan, and they don't say it in such frank and blunt terms, but that's basically what it implies. The reason you're downgraded is there's greater risk, and the risk, of course, is return of your principal amount. So if you loan 1,000, 10,000, 10 million, 10 billion, or 10 trillion, it matters. But what the point is do you get your money back? And on top of that, what's very often neglected is if you did get your money back, would it be worth anything? And that's, of course, a subset of the main topic, but we can explore that later. What I took out of this Telegraph statement was that they state, if we see again that the EFSF's long-term obligations are fully supported by guarantees from the EFSF member grantors rated AAA or by securities rated AAA, we would likely raise the EFSF's long-term rating back to AAA. So that's a rather ambiguous statement, and that's the reason being is that they're going to cover paper with more paper, and the paper that they're going to cover it with is triple rated. Well, the only thing that's triple rated is something that you can have a pretty much assurance that it can be paid back. And as far as I'm concerned, even though Germany hasn't been downgraded, there isn't really any sovereign nation out there that has the ability to pay back the loan amounts that are currently on the books, let alone the amounts that's going to be loaned over the next year, 2, 3, 4, whatever. So I think that's kind of just a puff piece, and I want to make that statement because anyone that really thinks that they're going to be able to make this better by backing some paper with some other paper is not in the real world as far as I'm concerned.
Well, speaking of being in the real world, let's talk about Greece resuming talks with its private sector creditors and in an attempt to avoid default here. Do you think they can reach this agreement? Or better yet, they're doing an investment tour in the U.S., which we all find very intriguing because I'm not really sure who they're going to be approaching to actually finance them. David, what do you think?
When you are an investor and you have the opportunity to invest in a company and you have the choice of buying equity or loaning money as debt in a bond format, the bondholders have the first rights. So let me explain that. Let's say that XYZ widget company, which is the term you always use in business, manufactures widgets at a profit, and they've been profitable for quite some time, and you loan them $10,000. It's secured by the factory and all of the materials that are in the factory, any real estate, any holdings. In other words, the bond has some security to it. If that business fails, so let's say widgets are unpopular and the business fails, it's the bond holders who have the first rights to whatever assets are liquidated. So that is how the bond market is set up. The equity holders in that same company only share in the profits. Well, if the profits are zero or negative, they owe more debt than they can pay off. The stockholders, the equity holders, are left holding the bag, so to speak, whereas the bondholders divide up the remaining assets. Now, the reason I went through all of that is to make a very important statement about this Greek situation. I don't know if we can see that or not, but I found this on the internet. And what's interesting is what's really going on that a lot of people are not talking about. But I'm just going to read the last couple of paragraphs here. And it talks about what I just mentioned, securitizing some of this bond or some of the Greek debt by assets. So in December, Greece sold 4 disused Airbus A340 jets for $40.4 million, a sum which aviation unionists dismissed as scrap value. The privatization list includes ports, regional airports, utilities and motorways, a leading casino, public-owned defense, train and mining companies, and a key stake in Greece's monopoly gaming operator. Now, let's get down to brass tacks here and really get into this. What we're really seeing right here is that, well, Greece, we'll loan you the money except we're going to have it secured. We're going to buy your country. We're going to grab everything of any value whatsoever. In other words, we're going to extract all of your real wealth, your tangible, honest to goodness wealth for this paper, for this fiction, for the stuff we printed up out of thin air and you bought into because you needed the money to keep going. And that's the situation at hand, Tracy. So I don't know who else is talking about this in that depth. I'm sure it's certainly not just me and you, but I think this is kind of a wake-up call to everybody. Bonds usually are secured by some type of asset. This is a case in point where Greece is to sell bonds backed by state property. That's the title. You can double check what I just said on the internet. This was produced on the 7th of January by BREITBART.com.
This week, the IMF warned that Europe needs to take bold action to avoid a downward spiral that could set the world's economy into catastrophe. What steps should be taken?
The steps that should be taken is never to get here in the first place. Bad answer. We are here. Really, there aren't any steps that I can see that can be taken at this point. Massive austerity across the board, and that's what no one wants. I don't want it. The Greek people don't want it. There isn't anybody that wants it. So we are going to see this imposed, like it or not. In other words, markets at times become very efficient. And so again, as we've discussed previously, and it bears repeating, you're either going to see more debt piled on top of, debt that already exists, so good money or after bad, or you're just going to see, or simultaneously, the currency weaken. So as the currency weakens, you're going to see less and less economic activity. And that's what's going to happen. And of course, less economic activity means lower wealth for everyone, and the pie shrinks, so to speak. And that's self-imposed austerity. That's what will take place. Whether it's mandated by the state and saying we have to tighten our belts, or it comes about by market forces, I think it's going to come about.
David, thank you so much for joining us this week. And